the most important part of this discussion about what the Fed should and should not do is really to think about the framework that the Fed has now used literally for decades, which is the Taylor rule. And the Taylor rule is just a fancy way of saying that what the Fed focuses on is its dual mandate. It focuses on where are we relative to full employment, where are we relative to inflation at 2%. And if you take the traditional way of looking at this, you will find that the Fed funds rate today, it actually, according to those frameworks, should be lower, namely around 4.5 relative to the 5.5 where we are. So what I was pointing out on that note was just to say, well, at least if you use the traditional frameworks, the traditional way of thinking for the Federal Reserve, there are some signs that because inflation has come down so much, that we should already begin to see soon the Fed begin to cut rates.
Have you got some sympathy at all for the prudence rather than a preemptive Federal Reserve? You know, they've been so wrong on so many calls for so long. I've sort of got a bit of sympathy with them in terms of being so reluctant to get caught short again. Even though core PCE is at a 3-year low, inflation expectations are down. Is it good governance to be as prudent as they are at the moment?
Well, that's absolutely right, Manis. And also, exactly as you're highlighting, they have traditionally, particularly the Fed, but also the ECB and the Bank of England, they have leaned more towards the direction of caution, meaning being more careful, not celebrating too early, because they run the risk, of course, in particular at the moment where the housing market in the US is beginning to recover. Case-Shiller home prices are up 5%. They're likely to go up more over the next several months. And remember, housing has a weight of 40% in the CPI basket. So if housing starts to recover, on Friday, wage inflation is expected to be 4.1 average hourly earnings, just like what we had in the month of December. So there's certainly a number of tailwinds to inflation that, exactly as you're highlighting, may suggest that we should not be cutting rates at this point. That's also why the Fed is probably comfortable with current pricing for March being 50-50, because that leaves the optionality, that leaves it flexible for them whether they are going to cut or not, because we still get a decent amount of data that will become very important for that decision, whether it is time to cut rates or not.
So obviously we're going to get this Fed meeting on Wednesday. Market's 50-50 at the moment. It depends what day you look at the function on Bloomberg as to whether we're, 62, 47, depends on the nuance and the mood. But when we look at Wednesday, here's what a number of people have written, is that we could get a mini curtain raiser or a dovish pivot, similar to, let me just give you this, 2019, in July 2019, when we had a rate cut, uncertainties about this outlook have increased. Well, we know there's a number of uncertainties, and there's a number of known knowns. Do you think that they will or should use Wednesday's meeting to invect a more dovish pivot?
I do think that we did turn the corner with a pivot in December. That was, if we look back in history, that will be a monumental change in Fed communication. Was it justified? There's a lot of discussion whether they made it a little bit too early or whether they should have waited. But it's very clear that they are signaling now that the next move for rates is lower. So what I would expect for Wednesday is that they will be signaling that this was the change in the communication in December, that rates are moving lower. So as you're saying, Manis, I would expect that dovish communication to continue to signal that rates are indeed going down from here.